having the business experience and building a company and building a brand and wanting it to be, the best thing that we could build, and then having experience as an LP investor and identifying, bad experiences and trying to improve on those. Which really allowed us to back into, hey, we want to be very professional operators. We want our investors to have, not only great investments, but a great experience investing.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real estate experiment. What is happening, y'all? Today, I have the pleasure of having Ryan Webster here in the lab with me, and we were just talking offline. We don't have Warren with us today, but that's okay because from what I see, you guys have been able to build something very special together, and to have you both, one of you guys here tell the story is definitely going to give us a good, strong core foundation of what you've done at Equity Yield, which I love. Good branding name, by the way. I love how you guys came with that. What's very interesting is I want to give you the chance to level set and give Experimentation an intro. It's been a minute since we've had, on the multifamily investor side. As you guys know, recently we've been kind of diving into the short-term rentals here in Experimentation. So it's always a breath of fresh air to have another multifamily expert in the space who has a strong background in construction as well and development, which I'm very excited to kind of hear that side with how things are turning out into the current marketplace here. So without further ado, I want to welcome you again, Ryan Webster. Welcome to the lab, my friend. How you doing today, man? I know you're dialing in from the Midwest here in the lab. So what's going on? How you feeling today?
Yeah, no, doing well. Appreciate you having me on the show here. Exciting stuff as always.
Absolutely. So tell Experiment Nation a little bit about how you guys build Equity Yield. And before you go into it, maybe give a little bit of background, because we always like to ask, I believe that truly we ourselves are a reflection of our business. So whatever our core values are, we'll primarily instill them in our business and the people that we work with, etc. So maybe before you get into Equity Yield, tell us about a little bit of who you were in the beginning of your experiments, and then who you are today, and what led to the big experiment, which turned into a phenomenal company where you guys are helping investors and helping yourselves get deals and again acquire at scale here in the Southeast.
Yeah, no, absolutely. So prior to founding Equity Yield Group, I owned and operated a construction development company here in the Midwest, and really the driving factor between the transition, out of the build and sell model into the buy and hold model was really kind of in midlife, hitting a transition point. My kids are, they're getting a little older, and it's only a matter of time before, they don't really want to spend any more time with us. So I wanted to capitalize on that time that we had and started looking at, that I had built a successful business, but I didn't have that time freedom. So I wanted to, like most investors, make that shift from working $4 to investing in something that's going to generate dollars, so I can get some of my time back and spend it with my kids. And that was really the core focus in that transition. So decided to shift and start the new company, Equity Yield Group. And we founded the company with really two core principles. The first of which was buy quality assets and generate solid risk adjusted returns for ourselves and our investors. And then really on providing a superior investor experience. And my partner, Warren, he's invested as an LP in a number of deals before we had founded Equity Yield Group. And what he found was there's varying levels of professionalism and communication with investors. You have some sponsors that are very good, and you'll get monthly reports. And if you have a question, you can get them on the phone or get them to respond with emails. And you have some sponsors where you invest in the deal, you send them your money, and you won't hear anything for 12 months. So we decided that we really wanted to focus on the investor experience and, our investors' journey through, what they wanted in their portfolio. So really focus on providing, clear, transparent communication consistently. We have reports that go out on the 15th of every month. And we're always available, via phone or email to answer any questions that our investors or prospective investors may have about their investment.
That's very unique. I haven't really heard anyone kind of just start from. I mean, we talk a lot about why we're doing it, right? To well, passively invest with us, etc. But we don't really talk about the relationship between investors. But before I go there, I want to take a step back because you said something that was very key, which I love. You said, build to sell, and from going build to sell to going to buy to sell, which I think is really neat because that's the concept of your construction background, where you're literally building to then literally sell the units, and now you're investing in them. Now tell me about what that looks like. Is it traditional syndication at Equity Yield Group? Is it, what typical life period are you holding onto the deals? Is it still value add? I mean, what's the play? Is there a core competency, or is it pretty much what we understand it as, and you're focusing more on the experience of the investor? We want to talk about a little bit about what makes Equity Yield different from everybody else.
Yeah, so we'll start with our kind of investment thesis,
Yeah.
which is kind of a mix between, my partner Warren and I's risk tolerance and my experience as a developer and on the construction side. And what we kind of backed into was, first and foremost, we buy the market first. We're looking for markets that have strong fundamentals, sustainable growth trends, that have, good affordability index, something where you have the incomes that can support the rent growth, and that are supply constrained areas with high demand pressure. And then we go into trying to buy the highest quality asset that we can. So our kind of sweet spot is this, what we call A minus. We like the late model product, this 90s, mid 2000s product. And that's for a couple different reasons. Partly because of the physical asset. I spent a lot of time, building properties and remodeling older properties. And I'd like to stay away from the older properties where you have a ton of deferred maintenance, and there's a fair amount of execution risk that comes with trying to do heavy lifts and big renovations, because there's going to be some unforeseen costs there. No matter how good or experienced you are, something's going to pop up and it's going to be expensive. Outside of that, the newer properties tend to be in newer areas. So they come with a certain demographic and tenant profile that makes it easier to grow the business at the property level. They tend to be higher income areas. They tend to be communities that have, better community amenities, and they're desirable areas. So you get a little more demand pressure because people are moving into these areas instead of out of these areas. But the A minus piece is, we're not in the luxury class A space. We're in the affordable class A space. So we represent an affordable component to the big, nice luxury properties, but we're still very nice communities, well amenitized. Unit interiors are nice, but we do get a little bit of a value add component. And the key to this is really return on cost. So the A-class properties, generally, there's no deferred maintenance. Exteriors look nice. They're well amenitized properties. But sometimes you come across one where the interiors are a little bit lacking. They're either slightly out of date, or the developer had to get cheap somewhere, so they chose to get cheap on the interiors. And that's where we're able to come in and do some very cosmetic interior renovations, and kind of move that property up in the comp set while still representing an affordability to the luxury space.
So let's talk about that affordability, because I think it's all relative, and I'm jaded, right? Right now I'm recording this from New York, right? So you talk about affordability. I mean, it all depends. You're in Manhattan, you're renting like 4,000 a month, right? 5,000, even, if to say the very least. So for context, because people are listening to this from all over the world slash nation, what is that affordable? And when you say higher income, what are we talking about, just for context of understanding what A minus product is like, what the demographic is like, just out of curiosity? What are we what's the range that we're talking here?
Generally we're talking, again, it's all relative. So the way we like to look about it is rents to income. Those are the two metrics that you need to find the ratio on. And affordability is generally defined as, your housing allowance is, 30 to 33% of your overall annual income. And so when you're looking at doing a value add project or any sort of project where you're planning on moving rents, you need to take that, post renovation rent or the target pro forma rents, and then look at what income do you need that's going to represent, 30% of the budget. And then go look at the demographics of the area and say, hey, are the jobs here, are the incomes here, they're going to support that rent level? And if they're not, then it's probably not a great investment. You're going to struggle to achieve those target rents because it's going to put too much pressure on the consumer budget. And especially in, we talk about inflation right now, not only are rents going up, gas is going up, groceries are going up, everything is putting pressure on the consumer budget. So you really have to be mindful of where is that affordability threshold of housing as a percentage of the total budget.
I'm so glad you went there. I'm so glad you went there, Ryan, because as I'm thinking of this, you're talking about cosmetic, and I'm very curious to hear what that looks like as far as when you're maybe again increasing the yield of how much you can, again, equity yield, no pun intended there, but as you're increasing the gross revenue of how much you can actually bring on net operating income per se, how much are we talking up by? Is it like $100? Is it 150? And the reason I'm asking this is because, what are you seeing now? And there's some things where there's kind of an alarm of, hey, actually our business model is a little bit impacted right now with inflation, because now you got to factor in that, it's an extra, it's cutting in, the lifestyle is going to cutting into kind of our gross of what we can actually, charge more. Like, is that how you think? And is that what you're facing now? And what does that even look like as far as the margins when you're saying value add and an A- property? Are we talking like a $200, $300 gap? What does that look like for our listeners who might be listening to get some good context here?
Yeah, it was a couple different things. And I'll give you an anecdote here, but it starts with why it's so important to buy the market first. The market is really the thing that's going to determine how much the business at the property can perform. So you need to be in a strong market. And what we underwrite for, post renovation rents and what we actually achieve are totally different. So typically, we're looking anywhere from $100 to $200 pop on underwriting for renovation. When we back into this, what we're trying to find is a direct post renovation comp. So we're searching the comps that we're trying to find, quantitatively and qualitatively, the closest property we can to the product that we're going to make post renovation, and look for a delta between the rents that we have and the rents that they have. And, sometimes that's $100, sometimes that's $200, but that's how we kind of back into what is our target pop on these renovated units. Now, what we've seen, because we've bought very strong markets, we underwrote, $150 renovation bump on a property we bought 12 months ago. We're seeing anywhere from $450 to $500 on these renovated units from where rents were. And that's allowed us to, 12 months after purchasing that property, to refinance that property and return $5.5 million of equity to our investors.
Hold on, time out. You can't just say that casually. That's crazy. So why such a large gap? I mean, is it because you're being conservative? And when you talk about that bump, I think you called it like 100 renovation bump. Is that what you called it?
Yeah. Renovation bump. Yeah.
So how does that 2.5x almost, like, how do you do that?
Again, it's the market. So we found at the time that we underwrote that deal, prior to putting it under contract, we found our renovated comp set that consisted of 3 properties that we identified to be direct comps for our renovated product. And we're seeing, $150, $200 premium on those units. But we also bought in a market that had seen huge population growth, had seen, income growth in excess of 38%. It's a very supply constrained market that has been historically. And then you add in kind of COVID and the supply chain issues, it's harder to build properties now. It's more expensive to build properties. So the new product isn't coming in as fast as, the demand is, as fast as people are moving to the market. So yeah, at the time that we underwrote that deal, the market was showing us, hey, the comps, there's a $200 premium here at best. And then as we've made our way through the year, the comp set moved because, there's just so much demand pressure in the area. And most of the properties in the area are 98, 99% occupied.
Got it. And what area was this specific case study in?
Sarasota, Florida.
Florida. What is it? What do you from your experience, what is it with the area like Florida? Like if you were to just give a quick overview of what's happened at a macro micro level, like what has it always been like this? Is it Florida? Because we hear Florida across the board, whether it's short-term rentals, multifamily, taxes. What is it that makes Florida, and maybe there's some areas that are not so desirable, but you tell me what makes Florida so desirable?
Again, it's like anything else. It's market by market, but I think Florida as a whole, it's a nice place to live. It's very tropical. It's like paradise. The weather's pretty good year round. There's a couple months in the summer, depending on where you're Florida, they get a little hot. But I live here in Cedar Rapids, Iowa, and come winter, it's negative 15, and that's pretty brutal. So I think there was a lot of people, post COVID, we had this big migration shift where we had this work from home model, and that allowed a lot of people the freedom to move. And I think there was a mindset shift post COVID of, you know, life short. Do I want to, live this life, or do I want to live my best life? And I think that drove a lot of people to consider, where do I live and where do I want to live? And they took the jump and they moved. And with respects to Florida, Florida's business friendly. There's no state income tax. So there's a lot of jobs in Florida. Jobs are growing in Florida, and they're usually good paying jobs. So when you couple that with, you have the retirement crowd that's also moving to Florida again. I want to live my best life. I've spent most of my life working. What am I going to do with my golden years? Well, I'm going to go down to paradise. So you have this huge influx of, migration, and it's driving population growth in Florida.
Absolutely. Well, that's neat. So let's I want to touch on, a few things that you had kind of said earlier, as it relates to, the investor experience, which I think is one that, we don't always get to talk about. Talk about the operators, we talk about the deals, we talk about the team, but then somehow we almost kind of, and I know you guys don't forget, but sometimes we don't even talk about what that experience looks like as an LP. So what gap are you trying to close? Is this from experience? Where does that come from, you trying to cater to that experience?
Yeah, I mean, it was from a couple things, having the business experience, and building a company and building a brand, and wanting it to be, the best thing that we could build, and then having experience as an LP investor and identifying, bad experiences, and trying to improve on those, which really allowed us to back into, hey, we want to be very professional operators. We want our investors to have, not only great investments, but a great experience investing. And then, if you think about limited partner, LP investor, they are partners in our business. We couldn't do it without them, and they can't do it without us. But a lot of times they don't get treated like partners. They don't get the transparency that a partner should have in a business.
Got it. Do you think it sounds like do you kind of almost toggle it to, how much visibility do you want? Because some people are passively investing to be passively involved. How do you guys, is it kind of like, hey, here's the option to have more visibility if you want to? Is that more the idea, or is it more of getting feedback from the marketplace where, limited partners actually don't want quote unquote be limited? They do want to have visibility and access to you guys. Like which one, how have you found that balance, and which one do you think it is?
So I think first and foremost, that they are passive investors, and they want to be passive investors, and there's a beauty in passive investment. It is, money that you don't have to directly work for, and that's, as an investor, you want as much of that as you can get. But first and foremost, I think they want communication, and consistent communication, because that's what I want as an LP. I want to know what's going on with my investment, and I want to know consistently, and every month or every quarter, I'm going to get an update. And then we break down the update into a few different components, and this is where the investor can choose, how deep they want to dig. We start pretty high level with, executive summary, kind of talking about the qualitative components of the business plan and execution, some bullet points. And then we track key performance metrics and measure those kind of performance against projections. So at a glance in the first page, they can look at it and tell me, are things going, are they exceeding the plan? Are they going according to plan, or do we have some deficiencies somewhere? And then we send the entire financial reporting package. So if they want to dig into the general ledger or the P&L or look at the trial balance sheet or the bank reconciliation, they can dig in, as detailed as they want to go and see, and then they can contact, our sponsorship team and ask any questions they may have about that.
Interesting. What does that look like from an experience perspective? Is that via a portal? Like, is that via an app? Like, is that built in house? Do you guys leverage third party applications? Like, what does that look like?
Yeah, so we have an investor portal. Each investor signs up for their own investment portal at the onset of the investment. They have a login. They can view each of their investments. All the updates go through their monthly, their capital account, distributions go through there, as well as all of tax documents.
Awesome. Do you guys use it? Is that in-house? Is that an in-house tool you guys use, or is it a proprietary tool, or is that like a third-party tool?
It's a third-party tool that's integrated into our website.
Oh, that's really neat. Okay, that's really cool, man. Because it and I don't know if this is how I would love to hear how Warren and you guys started working together, but as LP, I think typically they're telling investors, hey, join in as a limited partner, understand how it works, and then maybe there's a chance you either get more involved or there's a chance that you may want to do it on your own. How do you feel that as far as from equity yield, do you find that you're getting a lot more referrals from just the base of having individuals just having such a good experience, or do you feel that it's more at a like how do you keep that pipeline full of investors? Is it mainly focused on word of mouth, or how does that work in your ecosystem?
Yeah, there's definitely some word of mouth, and we work on putting some content out in the community and trying to provide knowledge and things that would be useful to investors and other sponsors. But what we've really found is the experience-based piece seems to get overlooked by a lot of sponsors. So the majority of our investors seem to be investors that understand syndication. They've invested in syndications before, have a baseline experience to generate what they really want out of investing in a syndication. And some way or another, they've heard about us, and a lot of our investor calls kind of go with, what have you invested in before? What are you looking to invest in now? And we always end up on the same kind of topic of, this was my experience before. I've heard about you guys. I'm looking to have that experience.
Experimentation, I always experiment. And the reason why is I'm always trying to find the best tool, the best method, and the best vehicle to help me get to my end goal. One of the tools that we use in the short-term rental space is Guesty for Hosts. Now, Experimentation, you know that I love to test things, and I wouldn't be sharing with you anything that I don't use myself. As a short-term rental superhost, Airbnb superhost, listings that we own and co-host at the same time, I can tell you that there's no better software that allows us to streamline our business. Right now, currently, there's actually 3 properties right now that are currently where guests are checking in, and I'm here with you, and I did not need to send in check-in instructions for these current properties, right? There are multiple ways that you can streamline your operation, from on the front end and on the back end, from being able to create a website, from being able to get income reports for your team, to looking at statistics, to setting up auto reviews, to integrating your smart lock so that you don't have to sit here and send every day and remind yourself to send the passcodes for your smart locks. No, instead you can integrate directly the exact same way that you can actually send your cleaners a link so that they don't have to remind themselves when they need to go to cleanings. There's text reminders that go out. There's links that can go out for them. This is a tool that if you're looking to give a smooth experience for your team on the back end, it will truly reflect, and it does, for your guests on the front end. Make sure you go to host.guesty.com and use our unique link. Our unique link will be in our bio, in the show notes. If you're currently watching this, you'll see it right here at the bottom of my screen. Use this unique link so that you can tell Guesty that I sent you. You don't want to miss out on this. You need a PMS, property management software in your business if you're looking to operate like a super host that you deserve to be, so that your guests can have the best experience that they deserve to have at your properties. Again, that host.guesty.com. Use our unique link that is here on the screen, in the bio, and in the show notes if you're listening to this, guys. Happy hosting.
Can you talk about that for a second? This is me out of curiosity. From a marketing perspective, I have a marketing agency. What is the number one source you would say today? You know, it's Q3 now. In 2022, that you find to be the most effective to get more investors into your pool, just from a marketing perspective? Like, what is the number one source that you find is where you convert the most? Do you know?
No, it's a bit of a mixed bag. Some of them we get where, they've heard from other investors that have invested with us word of mouth. Some of them we get where they heard us on a podcast like this and wanted to learn more about what we're doing. And that's really probably the two biggest ones for us.
So podcasts,
and then, just referrals from other, investors that have already invested with us.
Do you actually are you guys capturing some of that data, like as they come in? Where did you hear from us?
Yeah, so we capture that on the intake form, and then we, on the follow-up calls, again, ask them, hey, where did you hear about us? Because we'd like to know where to best apply our efforts.
Would you say it's 50-50, or what are we saying here?
Yeah, it's pretty close to 50-50.
That's incredible. That's an incredible vehicle from like, I mean, again, we're saying this because we have a podcast and we've seen how powerful it is. But it sounds like even being on, what you're doing right now, being on other people's podcasts as well. Do you guys have your own podcast, or do you typically just go guest on podcasts as well?
No, we don't have our own podcast. It's just mostly interviews just like this one.
That's awesome. Yeah, that's so effective, isn't it? So I want to talk about just because you guys are big on this when I go on the Equity Yield website, talking about core values and being in alignment, etc. Talk about how you and Warren kind of formed as a team to kind of like lead this thing and co-founded this thing together. Like, how did that come about? I know you told me personally where you were at in your life, but then how do you find a partner that is either maybe complementing some of your gaps, or either adding on to some areas maybe where you just don't have the time, or you're not skilled in? Like, how did that come about as far as a partnership?
Yeah, I think probably one of the few partnerships that developed very organically. So we were part of a larger syndication networking group. And at the time we happened to be looking at a lot of the same deals in Florida. And then we started going after some of the deals jointly, and then had a larger conversation about, hey, what makes a good real estate investment? What do you like about this market? What do you like about this particular asset? And found out that there was a lot of alignment in the investment thesis. And then started talking about, okay, well, how do you run a business? What are the things that are important to you? What are your core values? And again, found a lot of alignment there. So decided to continue working together, and then it just kind of grew from there.
That's amazing. And then as far as the when you're looking at coming together as far as a partnership goes, not to get too into the semantics of how that works, but do you look at someone who's like, oh, you're really good at that, like, you should do this and I should do that, or does it even matter? Because I know we talk a lot about this is what you should look for in a partner, etc. What's your take on what makes things work with Warren and the rest of your team?
So as far as the partnership goes, I think alignment is the key there. Yeah, it's good if you have complementary skill sets, but that's not necessary, because when you build a team out, that's when you're filling the holes in the complementary skill sets. And your team doesn't have to consist of just you and your partner or partners. You build a team of employees and third parties and everybody beneath that. But if you're going to work together long term and really build a business or build something that's meaningful, you have to share a vision of what this is that you're building.
Yeah, that's very true, very true. Tell me, speaking of vision, right? Great segue as far as where we are currently in these times, where as an investor, as what deals, what do you kind of forecast, and what are you seeing kind of in your backyard as, whether areas you're going to double down in, areas where you're going to just kind of take a step back? Is there, as you're currently always constantly making adjustments in our lab, what kind of adjustments are you making in your lab, if any, or opportunities are you seeing as far as equity yield goes?
Yeah, no, there's definitely, I think we're entering a period where there's going to be some great opportunities to buy some really quality assets. They're not going to get extremely cheap because real estate's very valuable, but they're going to come at a relative discount. Um, we're in this kind of period of, the Fed's raising interest rates, and that's doing a couple things. That's causing some price discovery on commercial real estate. Because as investors, we're solving for cash flow, and after you take your debt service, out of the NOI, that your cash flow is left, and we're all trying to generate cash flow. But if your debt service goes up, the cost of that debt goes up, your leverage goes down, which requires you to bring more equity, which changes the denominator in the percent cash flow calculation, and then the dollar amount cash flow goes down. So we're seeing in some of the tighter markets that used to be three cap markets, we're starting to see some price adjustment and some relative discounts coming. But the other thing is the consumers also hit by interest rates. So your would-be first-time home buyers, they're going to be staying renters longer. They're getting priced out of the market. Builders are going to start thinking twice about how much more inventory do I want to put in the ground? How much am I really going to be able to sell when mortgages are 8%? So
Wow.
we have this huge supply and inventory problem that's only going to get worse because of this. So I think we're still going to see rent growth just because demand pressure is going to continue, and the supply is not going to catch up.
Yeah, that's a really good way to tie it all together. Because of the supply shortage is one thing, which then means there's an increase in price, which then so it's there's a I don't know that we've had, I mean, you've been around in this space longer than I have, but there's a lot of variables in this pot, right? I
Oh,
think
it's a ton.
there's a lot more than maybe your traditional 2008, right? It's just a lot that you're factoring in, which it sounds like in your lab you've kind of baked everything into your formula. And we always say when there's blood in the streets, there's definitely opportunity, right?
Yeah, absolutely. And I think we're approaching this time of opportunity. I don't think it'll be as big as it was in '08, where we had stuff that was, absolutely on sale and almost free. But I think we're going to see some good discounts. And I think, rent growth is going to maintain. I think occupancies are going to maintain because, there's a lot of things hindering supply right now, whether it be interest rates or whether it be supply chain hangups or labor shortages. It's really hard to build housing and build it quickly and efficiently right now.
Yeah, I think the biggest one that you kind of highlighted, it's kind of yeah, it's double edged. It's the cost of, on the building side, from your experience, you calling that out, it's the cost of building going up. But then on the other side, you mentioned, buying with higher interest rates means that people might be hesitant to buy because or be priced out where they can't even afford a mortgage at 8%. So it's an interesting dynamic there that you're seeing, which then also gives you the opportunity to increase your rents on your side because due to the shortage of supply. Jeez, if you could, we need to draw out that formula, but that's very interesting. There's a lot of nuances there, plus more. I'm sure that we don't have all the time to cover today as it relates to just a lot involved in the economics right now. But tell me, as far as you kind of mentioned of what you guys are seeing opportunities are next. We love to kind of like have predictions here in the lab. You came here, it's July 2022. Where do you want to take equity yield? It sounds like you guys are making some real nice waves into here in the Southeast. What's next for you guys? Are you guys doubling down on the markets that are you expanding, or even just internally, what is the next step for you guys as you look to kind of hit the ground running?
Yeah, absolutely. No, we did last year a little under 200 million of acquisitions. We'd like to
Oh,
at least do that again this year, if not a little more. But as we're in this kind of price discovery mode, the opportunities are a little fewer and farther between. We have to underwrite more deals than we did last year to win the quality ones worth winning. So we're working on kind of scaling the team to do a little more work to dig up those quality deals.
Awesome. Is it deal by deal, by the way, or are you doing any funds or anything like that, or is it more syndication strictly?
So yeah, we do have our equity yield growth fund, which allows investors to be diversified, across 5 to 10 different assets, depending on what we acquire and the value of those that we use to fill out the rest of the fund. But there's some different benefits for investors investing in a fund. Beyond diversification, you also kind of get the benefit of being able to kind of invest in a time machine, because if you're coming into a fund that already has assets that was purchased with cheaper debt before rates started going wild, those deals are going to have higher cash flow that's not available on the market today for acquisitions. So when you blend that all together, you get a little better net result.
Question on the acquisition side. This is more of just a lab question here, just even for myself and experimentation. When you're operating, how do you decide what goes into a fund and what's going to be strictly siloed as a individual syndication? Like, how do you make that call?
It really depends on, investor appetite. Some investors, they don't like being in a fund. They like to pick their own assets and build their own portfolios. And some of them do. But we may have part of an asset that is open for individual syndication and part of it that will go into the fund. So it can
You're
go
talking
either
about the
way.
same asset?
Same asset, because we can break out 50% of the equity in a particular asset can go into the fund and 50% can go out to the common equity shareholders.
Wow, that's crazy. I did not know that. Um, that's fascinating. Really interesting. So blending and blend. I've never heard of that before. I can only imagine as an investor though, are making the decision up front of which one is which, right? You don't get a blend, or do you?
Well, if you're invested in the fund,
Mhm.
all 10 of those
Right.
assets are going to blend together and you'll own a piece of all of it.
Mhm.
But yeah, if you're doing, investing in individual assets, you're essentially kind of doing the same thing, because you get to pick which ones you pass on and which ones you invest in. But there's a little bit of economies of scale and cost savings that come with the fund structure from an operations side, as opposed to individually picking deals to invest in.
Got it. Now, in a 200 million plus portfolio, how does the disposition look like? Are there some that you're just trying to buy and hold forever, and then obviously with the syndication model having to pay out investors, you're liquidating some? Like, how does that ratio look like internally when you're kind of managing a fund slash portfolio?
Yeah, so we underwrite to a 5-year hold, because we got to put it in data in to generate returns for our projections. But as far as the actual hold period, it depends on where the market goes, what our basis in the asset is, what asset prices are doing. If we're very comfortable in our basis and asset prices have risen a lot since we purchased that, we'll look to do a refinance or multiple refinances, and then hang on the deal until it falls apart. But the goal is to get investors' capital, back one way or another, so they have the opportunity to replace that. But the best case scenario is, generate that infinite return. If we can pull out, a good portion or all of investor capital via refinance, and then still own the asset, still receive cash flow every month, that's the ideal scenario.
Right. Oh, that's amazing. Well, listen, Ryan, I can't thank you enough. I feel we could have an entire master class on kind of the back end of, how you operate as an operator and a fund owner and portfolio. It just pretty phenomenal stuff. But at the end of the day, you're here to obviously serve the people and kind of build your investor pool and continue to find the best deals for you and your investors. So, where can the people tune in a little bit more and find out about what equity yield? Obviously, I know equityyieldgroup.com is your website there, where you can have a look at and find out what you guys are doing. But is there any other call to action you'd like to give our listeners who kind of tapped in and who may be a little bit more interested in discovering what you guys do?
Yeah, the website is the best place, equityyieldgroup.com. If you want to partner with us on, future projects, you can sign up for our investor list there, get your own investor portal. If you want to see us on some of our other podcast interviews, that content's there as well. We also have, a knowledge center that kind of explains different aspects of investing in commercial real estate. We also have a passive investing guide for those that may not be as familiar with investing in private placements and passive real estate investing.
Awesome. We'll make sure we'll definitely include that in the show notes. I always say that if you're driving, keep your hands on the wheel. We'll have that in there. And obviously it's been a pleasure having you here in the lab with us. Again, that's equityyieldgroup.com. Make sure you check out what Ryan and his team are doing. And again, you guys are always leading with the core values, which I appreciate very much. But then you're also able to instill those same core values in the investment that you guys are making as well, and that's within your team. So that's a breath of fresh air. Ryan, cannot thank you enough. And just like that, we are out.